Cold reality. Markets don't crash quietly. They snap. They shock. And they punish anyone who believes this time is different. But for prepared investors, crashes aren't disasters, they're invitations. Why this matters? If you plan to invest for decades, market drops are not a possibility, they're a certainty. The only real question is whether you'll panic or profit. Experience without bragging. Over many market cycles, I've watched fear erase fortunes and patience quietly build new ones. The difference was never luck. It was preparation and behavior. The 3 types of market declines. Not every drop is the same. Understanding the type of decline helps you respond correctly instead of emotionally. Type 1, the reset. The most common drop is a market reset, a decline of around 10%. Think of it as the market exhaling after running too fast. Type 2, the grind. A deeper drop of 20% or more marks a prolonged downturn. These phases feel endless, but historically they are temporary. Type 3, the shock. Rarely, markets collapse fast and violently, over 30% in a short time. These moments are fueled by panic, uncertainty, and sudden loss of confidence. The uncomfortable truth. If market drops terrify you, stocks may not be your game, yet. Because volatility is not a flaw of investing. It's the price of admission. The 3 phases of a major crash. Big crashes usually unfold in stages. Miss the pattern, and you react late. Understand it, and you act early. Phase 1, overconfidence. This is when optimism feels universal. Risk is ignored. Prices climb faster than logic. Warning signs. You'll notice spending booms, easy credit, and sudden get-rich trends. When speculation becomes casual conversation, caution becomes necessary. Personal shift. During these periods, I focus less on excitement and more on discipline. I rebalance risk, not chase headlines. Risk control. The goal is not maximum returns. It's survival with optional upside. Emotional stress test. Ask yourself honestly, could you watch your portfolio drop 40% without selling? Debt discipline. Leverage magnifies results and mistakes. Reducing debt before chaos hits gives you control when others lose it. Liquidity is oxygen. Cash is not wasted potential. It's flexibility. And flexibility is power during uncertainty. Diversification reality. Concentration feels smart in good times. Diversification feels boring until it saves you. Phase 2, capitulation. This is when fear replaces optimism. Selling becomes emotional, not rational. The psychological battle. Everyone claims to be long-term, until losses test their identity. Conviction comes from understanding. You can't hold what you don't understand. Knowledge is emotional armor. Timing is a trap. Trying to jump in and out usually costs more than it saves. Missing just a few recovery days can erase years of gains. Accumulation mode. Instead of guessing the bottom, I focus on consistency. Small, regular investments during chaos compound quietly. Income matters. Stable income and side income turn downturns into opportunities. Cash flow funds conviction. Phase 3, renewal. Recovery rarely feels obvious. It begins while most people still feel cautious. New highs, new winners. Markets eventually surpass old peaks. But leadership often changes. Long-term pattern. Every major crisis reshapes behavior, but growth resumes. History doesn't repeat perfectly, but it rhymes. The core lesson. Wealth is rarely built during comfort. It's built during uncertainty, by those who stay rational. Final reminder. No one can predict markets, but anyone can prepare. Call to action. If you want to learn how to build a resilient investment strategy step by step, watch the next video on your screen. And if this helped you think clearer during chaos, subscribe. Stay calm. Stay invested. I'll see you in the next one.